it's been a big week for the investment banking community. The head of UBS in Australia, Matthew Grounds, announced he's leaving, along with his right-hand man, Guy Fowler. The duo, dubbed the A-Team, have been a big part of the success of the Australian franchise.
Yeah, globally as well, a sweeping overhaul at Deutsche Bank has seen the German lender shutting down its equities trading business and cutting 18,000 jobs by 2022. It highlights an increasingly challenging time for investment banking and M&A around the world as the compliance and regulatory burden constrains deal makers. For more, I spoke with Raymond Lee, MD and portfolio manager at Kapstream Capital, and I started by asking about the demise of Deutsche Bank.
Well, look, I think a lot of things happened. They've been really struggling to fix up their balance sheet from a capital and liquidity perspective. They've talked about all sorts of different solutions, even merger of Commerzbank. They finally decided to basically, cut 1/5 of their workforce and create a new bank or a good bank, bad bank situation, similar to what Citigroup did, which makes a lot of sense. Put all the bad assets into one entity and the good assets into another entity as an ongoing concern. But it is a big restructuring, so there is certainly execution risk involved in the solution.
It seemed like a lot of other investment banks around the world, Raymond, took the pain and almost swallowed the bitter pills, if you like, back in 2008 during the global financial crisis. Many saying that Deutsche Bank didn't necessarily do that, and in the years since it's come back to bite them. Is that how you see it?
I think that's one of the issues, and it's not just Deutsche Bank, it's all the European banks, right? So the US took their medicine very early and very quickly to shore up their balance sheet during the GFC, but the Europeans lagged in that, and by lagging, it puts them in a much more difficult situation to solve some of their capital issues. I think with Deutsche Bank, the other problem was over the last decade or two, they've really pushed into the investment banking business, and the structural trends have moved against them, and so executing that and making that profitable has been quite difficult. So there've been a couple of things that's kind of led them to the situation they're in right now.
It's actually been a really big week, hasn't it, for the investment banking community, because we also heard news that the head of UBS Australia, Matthew Grounds, will be leaving along with his right-hand man, Guy Fowler. They were dubbed the A-Team by a lot of commentary this week. What did you make of their leaving? What does that mean for the bank and the investment banking community more broadly?
Yeah, look, I think it's quite interesting. Look, he's been the head of UBS in Australia for, I believe, over a decade now. So it could be just, wanting to do something different or even take a break. So we're probably not reading a whole lot into it. Look, Australia is a very competitive market. It's a very small market and probably overbanked. So I think he's done a good job in running that business here and giving them such a great franchise. Look, the curiosity side of me just wonders what's he going to do next. He's obviously very qualified, and whether he might go into a new venture or something different remains to be seen.
Raymond, it's interesting because this big news in the investment banking community this week comes at a time when Wall Street is continuing its run of record highs. I know it closed this week very, very close to those record highs. So I guess, this news that we've heard from the investment banks really hasn't seemed to rock equity markets in any way at all this week. What do you think is driving markets right now?
Well, look, it's something that's very different. It's just the Fed, basically, right? So, if you look at fourth quarter 2018, when the Fed was hiking interest rates quite aggressively and the market was pricing in 4 rate hikes, you saw equities sell off peak to trough in the US, 10, 20%. Fast forward, 9 months later or 6 months later, with the Fed pivoting and rates being very dovish, equities have now rallied back and at all-time highs. So it's really a technical thing. I don't think it's fundamental. As long as the Fed remains to keep interest rates quite accommodative and the US 10-year remains around 2% or even lower than that, and the 30-year bond trading around 2.5%, if those numbers remain where they are or even go lower, you will see equity prices remain to be supported.
On the one hand, we talk about the equity market there hitting record highs, and you look at how the US economy is tracking, it still looks to be pretty strong. I mean, growth is, it's continuing. Jobs growth is very strong as well, 220,000 new jobs last month. Yet you talk about the US Fed as well. It seems like they've locked themselves into a rate cut by the end of this month, and that's only 7 months after they last hiked. What is that actually telling us? Do you think perhaps it's a sign that things are not so rosy?
Yeah, look, I think it tells us a couple of things. One, the Fed was probably a little bit too aggressive in its hikes last year. Obviously, the first half of 2018 had pretty strong growth, but they probably still hiked too much relative to that strong growth. And so, fast forward to now, they're basically in a position where they have to cut rates. So, our view is between July and September they'll cut rates at least once. And the Fed does have this tension, right? Job numbers, as we saw in the last non-farm payrolls, was actually pretty decent. But global growth and just inflation in the US is on the lower side of things. And so there is that tension. But certainly, look, growth right now, overall domestic and international, is much lower than where it was 12 months ago. And hence, the Fed has to reflect that in its monetary policy. So you'll probably see the Fed funds rate be cut by about 25 basis points in the next month or so.
So with talk of more cuts, and if in fact we do see that cut, do you think we're at risk of a recession?
Look, I think recession is probably still at least 12 to 18 months away, in my view. GDP in the US is still positive, around 2% or so. So for it to go negative in the next couple of quarters real quickly, I don't see drivers for that. I don't see big systematic risks that would let GDP turn very quickly and very suddenly. But look, US is in a 10-year expansion. The recession will come one day. It's probably not that far away, but I don't think it's likely to occur this year.
Raymond, with the talk of rate cuts now in the United States, you have more talk of rate cuts to come here in Australia. Is the hunt for yield becoming even more difficult?
Definitely. I mean, expected returns have gone lower in most asset classes, certainly in equities with its high valuations that we spoke about earlier, but also interest rates as well, right? I mean, global rates around the world have gone down. You have a record number of government debt that's in negative territory. Even corporate debt, I came across, I think, $600 billion worth of corporate debt is in negative territory as well. So it is very difficult. Look, I think from a portfolio management perspective, at least what we're doing is trying to not take too much risk. There's always this fear of extending it when you're hunting for yield. I still think you have to be very selective, and I think doing a lot of analysis in your investment becomes very important as opposed to just to buy anything and everything in a passive way.
So when you talk there about your portfolio selection or your portfolio management, if you are an investor that is looking to build, say, an income portfolio, or if you're a self-managed super fund, for example, where do you go?
Yeah, look, I still think you want a diversified portfolio, and it really depends on your risk parameters. Look, if you have a longer-term outlook, I think you don't want to be short equities. You still want some equity exposure in your portfolio, even though they're at all-time valuations. And if you have a long-term view of holding these things, 5, 10, 15, 20 years, you'll still do quite well. I mean, equity P's are at all-time highs, valuation, but P's are around 18 times, so it's not excessive. So you should put some equities into your portfolio. On the fixed income side, I'll probably avoid all the negative yielding bonds that are out in the market. Focus on developed markets that have higher rates. Clearly, the US at 2.5%, even Australia at 1%. That's high for developed markets. And I'll stay short duration in the sense of buy debt that's kind of 1 to 2 to 3 years, as opposed to buying longer dated debt like 10 or 20 years, where the yield curve is very flat and volatility is very high.
All right, fantastic. Look, Raymond, it's been an absolute pleasure. We'll wrap up the conversation there, but thank you so much for joining us today.
Thank you very much for having me.